annual State of the Organization presentation. I'm glad everybody can be here this morning. We're especially happy to welcome our guests. So I'd like to introduce to you, first of all, Gary Wheeler, who is the CEO of Front Porch. Thank you for coming, Gary. And Mary Miller, who is our CFO, Chief Financial Officer. And I think many of you know Roberta Jacobsen, who is the president of Front Porch. So the agenda, if you don't have an agenda, raise your arm. We've got a couple folks at the back, and they can bring you one if you don't have one. Carolyn, would you grab a couple of those and bring them up, Kevin? A couple of agendas, so people have their own raised. Thank you. So without further ado, I'm going to introduce right now Mary Miller, who will be reviewing the Front Porch audit. After Mary will be the role of charitability within the Front Porch family, and that will be presented to us by Gary Wheeler. Following that, Roberta Jacobsen will talk to us about the future of retirement communities, after which the questions which you submitted will be answered by those who have that particular expertise. Thank you.
Good morning. As Joan said, I'm going to be taking you through the material that was handed out. It's the audit for March 31st, 2013. Our fiscal year end is March 31st, so everything in this report will be March 31st, 13 compared to the prior year. So let's first go to the summarized income statement. And there's a few numbers here that I'd like to point out. About 3 lines down from the top, you can see that Front Porch had total revenues of about $172 million for the most recent fiscal year, compared to $164 million the prior year. That's 4.6% growth in our revenues, so a nice, solid, healthy growth rate. If you look a few lines down, looking at total expenses, you can see that the total expenses were about $168 million, compared to $162 million the year before. That's 3.5% growth in our expenses. So we were able to grow our revenues 4.6% while our expenses only grew 3.5%. Hence, the operating gain before other operating charges increased from $2.4 million last year to $4.2 million this year. If you look right under that line item, you'll see a line item called Other Operating Charges, Asset Impairment, Wesley Palms Redevelopment. It's approximately a $3 million charge that occurred in fiscal 2013. As most of you, I think, are aware, we've been working for a few years on a plan to redevelop Wesley Palms, and we have been working on a plan where we were thinking of expanding the campus to 450 units and making some really significant changes to the infrastructure on the campus. And as we worked on that plan more and did some more study of that plan, we decided that while we're still very committed to renovating the Wesley Palms campus, that the specific approach we were taking toward that wasn't the best approach in light of current market information and financial feasibility. So therefore, we wrote off what we had invested to date in that plan, and we're now pursuing an alternative plan. That's what that charge is. So net of that charge, we had an operating gain of $1,250,000 compared to about $2.4 million last year. And then I'd also like to draw your attention just below that to the investment returns. We had about a $15 million positive return from the investment portfolio in this latest fiscal year, which is very comparable to the investment return for the prior year. So we did well in the markets. Front Porch invests in a diversified portfolio of U.S. and international equities, as well as fixed income, and all of our investments are managed by a third-party professional investment manager. And then if you look at the bottom line on this income statement, increase in unrestricted net assets, we had an $18 million increase in our net assets this year, on top of a $16 million increase the prior year. So strong performance. And in summary, the events that affected our 2013 financial results were higher revenues in all levels of care, the continued fill-up of Walnut Village. You may recall Walnut Village is the continuing care retirement community that we completely redeveloped in 2009. I'm pleased to report that we're now up to 75% occupancy at Walnut Village and independent living, and 100% in memory care at Walnut now. We continue to be effective in managing our costs, which is why our expenses increase less than our revenues. We did, however, have a significant increase in our workers' compensation expenses, which unfortunately is continuing in the current fiscal year. And we already talked about the Wesley Palms redevelopment costs and the investment performance. So let's now turn to the next page, the summarized balance sheet. And there's just a few numbers I'd like to call your attention to here. We have a big increase in our cash position from 13 million to over 20 million. We normally hold in the range of 12 to 15 million of cash on our balance sheet, but at year-end last year, we were anticipating needing to hold a little bit more cash for some projects that are coming up, so we made a conscious decision to increase our cash balance. For example, we have the Villa Gardens, a 25-unit expansion that's going to be starting soon, and we're self-financing that, so we're holding a bit more cash than usual. You can see also our investments, about halfway through the asset section, increased from about 160 million to almost 170 million, so almost a $10 million increase in the value of our investments. Then if you look under liabilities, you can see that 3 lines down, deferred revenue from accommodation fees went up from 71 million to about 77 million, so about a $6 million increase. What that line item means is for the communities that collect entrance fees, when they're initially collected, they don't all get recognized as revenue right away. They stay on our balance sheet and get brought into income over time. And so the fact that this increased so much means that we collected a significant amount of entrance fees in the current fiscal year. Long-term debt went down from 274 million to about 265 million, so about a $9 million increase in long-term debt, and that's from paying down our principal. And then to me, the most important number on the balance sheet is our fund balance. Assets represent everything that Front Porch owns, and liabilities represent everything that Front Porch owes to anyone else. Fund balance is the difference between what we own and what we owe. And you can see that our fund balance went up over $18 million, which is primarily in the unrestricted fund balance. So that's very strong financial performance, very strong balance sheet. So let's now go to the key strategies for the future. And for those of you who have been with us for some time, these strategies are going to look somewhat familiar to you. We have not changed these this year. So the first strategy is continue to generate an operating surplus, exclusive of redevelopments, without consideration of investment and gift income. And what that means is that we want our communities to pay for themselves, their operations and their ongoing maintenance capital, rather than relying on withdrawing money from the investment portfolio or using money from gift income to subsidize the operations. That's important so that the operations of our communities aren't vulnerable during a time where the markets don't do so well. Number 2, continue to invest in capital improvements at a level that at least covers annual depreciation expense. I've been with Front Porch about 7 years, and this has been a strategy that entire time and probably before that. And I'm pleased to report that in fiscal 13, we actually spent more capital than our depreciation expense. We spent 24 million in capital, and our depreciation expense was 22 million. So we're very pleased to be able to afford to invest capital at that level. Depreciation is based on historical costs, and we all know that an asset purchased 10 years ago would probably cost a lot more to replace now than it did to purchase that asset 10 years ago. So it's still our goal to continue to improve our ability to invest in capital, but we're at least covering our depreciation expense now. Number 3, successfully fill Walnut Village, and as I previously reported, we're up to 75% occupancy in independent living there and 100% occupied in memory care. Number 4, continue to find creative ways to grow and build the financial strength of the company. This is something, we have a lot of examples of different ways that we've worked on this objective over the years and different things we've accomplished. One of the most recent things we were able to do, and I'll talk a little bit more about this in the questions, was we were recently able to refinance $50 million worth of obligated group debt, and we saved about 2 percentage points of interest when we did the refinancing, which will reduce total debt service costs by about $1.5 million. So that's a really good example of how we're building our financial strength, and we do have additional HUD refinancings planned in the near future. Number 5, manage the replacement of outdated assets. We're always looking to do that. And number 6, effectively manage our tax-exempt charitable status in an increasingly anti-not-for-profit environment by government seeking revenue sources. And Gary's going to talk a little bit more in his presentation about the profound impact that our charitable status has had on Front Porch and why that's so important. So let's turn now to the financial trend page. The top 2 charts are graphs of operating income and operating margin. So while the first is a graph of dollars and the second is a graph of percentages, they follow exactly the same pattern. So what you can see from this is that our operating income and operating margin percentage did drop down in fiscal 2013. The reason for that is the Wesley Palms redevelopment write-off that I spoke about earlier. Had we not had that one-time event, our operating income would have been $4.2 million and our operating margin percentage would have been 2.5%. And my favorite chart is the last chart on the bottom, days cash on hand. Cash is king in some ways as a financial metric. Cash is really important for a business to give that business flexibility and ability to weather storms that may come about. And you can see that Front Porch is in a very strong cash position. What days cash on hand means is how many days could Front Porch continue to pay all of its operating expenses without taking in any more revenue. And as of 3/31/13, we had 476 days cash on hand, so well over a year. And the Standard & Poor's BBB median is 341 days. We are rated by Standard & Poor's and we have a BBB credit rating. So when you compare us to our peers in the industry, we do have substantially more cash, which is a good thing. So in summary, we have very strong financial performance. I know that some of you submitted some financially oriented questions and we will go over those at the end. So